This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
Up until now, the figure of profit that we've been using within the taxation system has come from the accounting system. We've started the adjustment of profit process with an accounting net profit, and that net profit produced as per the accounting rules would have been computed on the accruals basis. Now, that is an issue that may give problems to individual, very small businesses. So what is available now to, indeed, very small businesses, we'll see the limit in a moment's time, is for them to elect for a cash basis to apply. Now, cash basis is going to be a whole lot easier. All we have to do is to work on receipts and payments. So we don't have to worry, therefore, about receivables, about payables, or about stock inventory, if you prefer to call it that. All we've got to do is look at the receipts, cash in, the payments, cash out. A couple of things there along the way in terms of issues that we have to contend with, but in essence it's a far easier system. Again, in terms of such small businesses, again we'll define the size of that small business in a moment, but in respect of such small businesses, the only reason why they really need to do accounts in the time-honoured fashion is to present to HMRC in order to determine the amount of taxable adjusted trading profit. So a very sensible and generous move indeed on behalf of HMRC to allow that profit for tax purposes to be computed on a much simpler cash basis. So who is entitled to use this cash basis, and then how does it work? Well, we're firstly only dealing with unincorporated businesses here, i.e. a sole trader or partnerships. We are not dealing with companies. Companies is corporate tax, and the cash basis is not available there. If you're a company, you have to, of course, follow the Companies Acts and the normal accounting procedures that therefore have to be adopted. So here, only unincorporated businesses. And they may elect, it's not compulsory, they may elect to use this cash basis to determine their tax-adjusted trading profits instead, as we said, of the normal accruals basis. Now, we have said here that it's only available for small businesses, and the election is available to those businesses with receipts for a 12-month accounting period. Again, the business will be able to prepare its accounts to any date it chooses within the year, no change there. But with receipts for such a 12-month accounting period, accessible then in the tax year, that do not exceed the V80 registration limits. Now, okay, we've not yet seen V80, but there is a limit in terms of the taxable supplies that it makes, the turnover basically that it has, that will require that registration to take place. And that's where the supplies, the sales by the business exceed £82,000. So that's the figure that's adopted here and we use for the cash basis. So we can see that with that level of turnover, that level of sales, we're not talking, therefore, about a particularly large business. It is indeed a small business. Now, once the level goes over 82,000, there's no requirement to immediately leave this cash basis. Indeed, the trader must only leave the scheme if receipts accessible in the previous tax year, as according to the accounting period and what we've assessed in the previous year, go to twice the VAT registration limit. Currently, therefore, 82,000 times 2 is £164,000. So we can stay in this, a trader can stay in this system for potentially a long time after, in fact, its sales, its turnover has gone above the £82,000 VAT registration limit. What will happen? Well, the cash basis, as we know, will assess a business on its cash receipts less cash payments of the allowable business expenses. As we've said, we don't have to worry about payables, we don't have to worry about receivables, we don't have to worry about inventory. All of that is ignored. But we mentioned here cash payments of allowable business expenses. So the accounting profit must still be adjusted for taxation purposes. So again, we're going to use the same rules in terms of adjustment of profits as regards whether a particular expense item is allowable. Now, that will still require us to add back depreciation, but what we'll see, although the majority of the adjustments of profit are the same as for the accruals system, the main difference being in relation to capital expenditure. Now, in relation to capital expenditure, what has previously happened under the accrual system is that we disallow depreciation, as we still do, but then we would compute and deduct capital allowances. What we will see now is that we've got a very different and a simpler system by which to deal with the tax relief for capital expenditure. So, expenditure on plant and machinery, which would normally attract capital allowances, so it's still qualifying plant and machinery therefore, will now attract tax relief with your capital payments for plant and machinery, except cars. Isn't it always the way? What was the asset that caused us most trouble when dealing with the capital allowances computation? Cars. And what it is now is an exception to this very simple rule, whereas when you make a payment for plant and machinery, that will be deductible. So we'll get tax relief on the expenditure incurred with quite simply capital receipts from the sale of plant and machinery, again except cars, being included in the calculation of the adjusted trading profit. So we will still work for the majority of plant and machinery on a receipts and payments basis. When we pay for the plant and machinery, that's an allowable deduction against our profits. When we sell the plant and machinery, then the sales proceeds, that will come in as a receipt and be taxable there. The only exception to that, cars, where we don't again get the tax relief for the capital expenditure incurred. Instead, we've got a very different way of dealing with it. Now again, we don't get, so in respect of cars, instead of claiming capital allowances, so we still don't get capital allowances, the trader may instead use a fixed or flat rate deduction for tax purposes. The actual capital cost of acquiring a car for use in the business, the running costs, and eventually the sales proceeds are excluded from the profit calculation. So there's no tax relief for the cost of the car, no tax relief for the running costs, the motor expenses incurred while you use that car, and then there's no taxability in relation to the sales proceeds. Instead, the way in which tax relief is given is a technique which in fact we'd need to know anyway, because in Chapter 9, when dealing with employment income, we may see a circumstance where an individual is required to use his or her own car for purposes of their employment, going out to visit a client, for example. And they may then be, and usually would be, reimbursed by their employer. And what we have is authorised mileage allowance payments, which, so long as those payments are made, nothing in excess of those payments, there'll be no assessable benefit so far as the employee is concerned. So the employee can be compensated for the use of his or her own car and the expenses that they therefore incur. They can be compensated through this authorised mileage allowance payment system. And we use exactly the same technique here. So what is this technique? Simple. The trader can claim as a deduction against the trading profit a mileage allowance, obviously there for the business mileage, not of course for private. So again, we'd need to segregate out and know what is the business mileage. And the allowance is at a rate of 45 pence per mile for the first 10,000 business miles. The probability is we won't go above that, but up to 10,000 business miles at a rate of 45 pence. After that, if we do have in excess of 10,000 in the period, then 25p thereafter. And that would represent the allowable deduction to put through in the calculation of your tax-adjusted trading profit. So the calculation that we do using the cash basis will be simple. We will have, firstly, our receipts, so the money coming in from the sale, including the money coming in from the sale of plant and machinery, though not, of course, from the sale of any cars there. What can we deduct? Expense payments. What has actually been paid there? At least that which is allowable for taxation purposes. If it's a non-allowable expense, for example, entertaining customers, for example, there. If we've got a non-allowable expense, entertainment, depreciation, whatever it is added back. But expense payments, including the purchase of plant and machinery, not, of course, cars, that would be deducted. In relation to cars, which we're likely to see, then we've got this little calculation to perform, and that too would be a deduction along with these other expense payments. If, for example, we had business mileage during the year of 8,000 miles, we go 8,000 times 45 pence per mile, calculate the figure and deduct it now, in deriving, of course, your bottom line tax adjusted trading profit. So it's a relatively quick and easy calculation to perform. All we've got to do is to look at our cash account, our bank account there. What's the money in, including the sale of plant and machinery, but excluding the sale of cars? What's the money out, the payments, including the purchase of plant and machinery, excluding cars, excluding any motor expenses? Then work out using the business mileage allowance rates, as we've highlighted here. What is the deduction in relation to the business use of your car? And once deducted, you've got your tax-adjusted trading profit or loss. Now, when we see an exam question, what we may have to do is what we've got here in example 6, which is actually to do the comparison in terms of what would be your normal adjusted trading profit for your accounting period as compared to what it would be using the cash basis. So here we go, we've got example 6. Now what I'd like you to do is to have a little read through that, please. You will see that the requirement, calculate Adam's adjusted trading profit for the accounting period ended May 31st, 2016, using the normal basis. Now here your main problem will be, can you remember the accounting way, your accounting system of how you would work out a profit? But then of course it must be adjusted for taxation purposes. Any disallowable expenses not allowed, and of course capital allowance given in relation to capital expenditure. So do a normal calculation of adjusted trading profit from the information provided using the accruals basis, and then a separate calculation using the cash basis. Now I will go through this with you in a moment's time, but I'd like you to have a little think about how you'd work out your normal adjusted trading profit here, and then how you would do your calculation under the cash basis, so that hopefully when I take you through it, I will be, as we say, preaching to the converted. You will know indeed the figures to include in each of those two calculations. So pause it for a moment, read through the question, have a little attempt for yourself, try to do this, don't look at the answer as yet in the back, have a go for yourself, and then put this back on and we'll see how you have fared. Okay, let's see what we've got therefore, to begin with using the normal basis. So the normal accruals basis would require us to establish the gross profit, sales less cost of sales, and then deduct any expense items that were allowable for taxation. Here we want the adjusted trading profit, and replacing otherwise a depreciation charge, we will have our available capital allowances, which will no doubt require its own specific working. So what have we got? Adam commenced trading here. Now, given that it's a start up on the 1st of June 2015, that means in terms of your cost of sales that there'll be no opening stock. All we'll have in terms of the cost of sales will be purchases less any closing stock that existed. Had it been a continuing business, then we would have to work out our normal costs of sales there. Again, testing your accounting knowledge rather more than your tax knowledge, I think. So, new business starting up, preparing its first set of accounts to the 31st of May 2016, for which the following information is available. Sales for the period were £61,000. Now, here they tell us of which £4,000 was still owed by the business. That, of course, will be relevant for your cash receipts basis. But for us, there's your sales information. The sales, therefore, £61,000. From which then we will look to deduct our cost of sales figure. So what are we told here? Sales for the period were 61, of which £4,000 were still owed by business customers at the end of the period. Inventory, so our closing stock at the end of May 2016, amounted to £1,800. Why do we need to know that? Because of course we're going to need to take account of it in determining what is our cost of sales using the accruals basis. So purchases and expenses of the period purchases and expenses of the period, all allowable, amounted to £29,000. Again, they tell us there of which £2,000 was still owed to suppliers. That's again for the cash basis. But for us here, our purchase costs and other expenses were £29,000, so our cost of sales, based on a purchase expense of £29,000, minus, of course, what was in closing stock. What was in closing stock, we're told, there we go, our closing inventory, £1,800. So, deducting our closing stock valuation at cost there from what would otherwise have been the overall cost of sales figure, 1,800 from 29,000 gives us, what's that, £27,200, £27,200. So a figure of profit there before dealing with our motor expenses and our capital allowances, a figure I think, but again do check my numbers, of £33,800. And from which we will deduct our motor expenses. Well, what are we told? As regards the other expenses incurred, Adam purchased equipment for use within the trade, costing £8,000. Now again, at the moment we're doing what will be just a normal capital allowance computation. So that, as you read through the question, using your normal rules, that would be a normal AIA. And very obviously £8,000 well within your £500,000 limit. And on the 1st of October 15, a car costing £12,000 with CO2 emissions of 122 grams per kilometre. Adam uses the car 40% for private use, so it's 60% business use that we're talking in terms of. Now, on a car with emissions of 122 grams per kilometre, in terms of your available capital allowances, what would we be talking about? It's not low emission, it's equally not high emission, so on that car we'd be talking about writing down allowance at what level? 18%. But of course that writing down allowance, also one other thing to check on here, this was the opening period. Now, in fact, the first set of accounts, we started the 1st of June 15 and we've gone through to a date exactly 12 months later, the 31st of May. Do understand that that opening period, again if you get such a question, does not have to be exactly 12 months. It could be short, it could be long, in which case that 18%, that writing down allowance, would be time apportioned, netted down or grossed up depending on whether it was a short or a long opening period that you were dealing with, just as we dealt with back in chapter 5 there. Not an issue here though, the accounting period is of 12 months and therefore your capital allowances will be 18%. However, yes, it's 18%, but what are we told about the usage of the car? Adam here, the proprietor, has 60% business use. So that allowance will be times 60%. We're also told there incurred motor expenses during the period of £3,600 in driving what was a total of 10,000 miles. Remember, of that 10,000 miles, 60% was business use. Right, so in terms of your motor expenses, the figure of motor expenses provided is £3,600. Using your normal rules here in terms of adjustment of profit procedures, working on the accrual system, we would be able to have as an allowable deduction here the business use element. That is 60%. So 3,600 times 60%, that would be the amount of the motor expenses allowable for taxation. Take 60% of that, and that I think is £2,160 as the deduction there. For capital allowances, I'd suggest here that you'd use working one, but hopefully you can do that calculation without too much trouble. You've got an AIA of £8,000, and you've then got a writing down allowance based on 12,000 at 18% times 60%. So your annual WDA for a CO2 emissions car at 122 grams per kilometre would be 18%. 18%, of course, there times the business use element, 60%. This would be a non-pool asset. You'd separate it out as a non-pool asset as it has private use by the proprietor, and you'd restrict to the 60% business use component. Well, if you work that figure through for yourself, you'll get your capital allowances. You can then take that figure away along with the motor expenses from the, what do we have, £33,800 of profit there to get the adjusted trading profit. Now, what I'd like you to do is just check that through with the answer. When you look at the answer, avert your eyes, please, from the answer for the cash basis. Or if you prefer, just leave it at that and then come back to this in a moment after you've paused and worked out your own figure of adjusted trading profit. And then, of course, what we will do is we will show how to use the receipts basis. Hopefully, of course, if you haven't already, you'll have had a go at that for yourself. Okay, now for the alternate basis that we can elect for, the cash basis here. Right, what are we told? The sales for the period, sales were £61,000, of which £4,000 was still owed by the business customers at the end of the period. So our receipts from those sales 61,000, minus how much is still owed, pardon me, £4,000, and that therefore will mean that we'd have had receipts of 57,000. A figure, of course, that we'd know from our cash account there and could pick directly from our cash account, as we've said. The payments, firstly, purchases and expenses. What are we told there? Purchases and expenses amounted to 29,000, of which £2,000 was still owed to suppliers, not yet paid. So our payments, therefore, in relation to purchases and expenses, 29,000 minus, running a bit short of space here, £2,000, and that therefore would give us some £27,000. Apologies for my presentation here. £27,000 to deduct. What other costs have we incurred? Equipment, purchases of plant and machinery. Again, as long as it's not cars, we get tax relief according to the payment. And we purchased equipment here costing £8,000. So the equipment, £8,000 deduction, in it goes. And then the odd one, the motor expenses that we can claim. Now, we don't take any relief in regards to the motor expenses incurred, so that was the £3,600. We don't take any relief in relation to the cost of the car, that was the £12,000. Instead, what we do, we calculate the amount of business miles. 40% was private, so of a total of 10,000 times, as we know, 60% will give us 6,000 as the business miles there. 6,000 business miles. 6,000 then, again, we will consult on our rates and allowances page. You will be given those authorised mileage allowance payments, the 45 pence per mile up to 10,000 miles and the 25 pence per mile thereafter. They're not numbers that you have to remember. It's provided again on your rates and allowances page. So we'll have, again, you'd show the full calculation, 10,000 miles at 60% is 6,000. But we've done that, 6,000 times 45p, and 6,000 times 45p is, I think, £2,700. So we take our deductions away in getting our adjusted trading profit. So there we've seen a simpler way of dealing with it. We'd have the payments and receipts information from our cash account. All we'd have to do, of course, is to exclude from that what we paid for a car and any motor expenses incurred, and instead give the motor expenses allowance at 45 pence per mile for every business mile up to 10,000 and 25 pence per mile thereafter. So check back with a note, check back with that example, and make sure that you are happy with that technique. In terms of the use of the cash basis and the likely involvement in the examination question, I've got to say, out of what we have to do here, what we have just done is by far the most likely involvement. You might possibly get an objective testing question dealing with the next and the final point, but certainly what we've just done is the most important part of the cash basis. Just another little exercise. Again, I think if this next exercise were to be tested, it would probably be in a Section A objective testing question. There isn't that much to it, in all honesty, but again, it's in the syllabus, we need to know. So pause at this particular point in time, check through, make sure you're happy with that, and then come back and we will finish off the final part of this exercise. Okay, then, let's finish off this exercise. Firstly, a little bit finishing off what we were just talking about. When under the cash basis, we've computed a trading profit. Now, what we may discover, and we'll look at the detail of losses indeed in the next chapter, chapter 7, but if a trading loss were to arise under the cash basis, we had more allowable payments than we had receipts, then the only relief available to the trader, the only relief available, it's a very simple one, is to carry forward that loss to set off against future trading profits of the same trade. Now, that might seem like a perfectly reasonable thing to do. If we make a loss this period, then we can carry it forward and set it against the future trading profits of that trade. What we'll discover in Chapter 7, in our next chapter, is where we work on the normal, the accruals basis, and a loss arises, there's actually a variety, a number of different loss reliefs that are available to us. So certainly a price that we pay in the question of choosing whether or not to take the cash basis is that we would have a restricted use of those losses as compared to the normal loss reliefs. This does indeed compare unfavourably with the normal loss reliefs, as we'll see very soon in the next chapter. That then may be, of course, a critical issue, especially for new businesses. When you start off a business, it is perfectly possible that it takes some time to build that business, and your costs and expenses to begin with are greater than the receipts that you get. And on that basis, therefore, you may indeed sustain losses. It may therefore be a sensible idea to start off with the accruals basis, gain the benefit of the more favourable loss reliefs available under the normal system, and then to elect for the cash basis at a later point in time. But it is an issue that has to be taken account of in deciding whether or not to go with that. That sorts out the issue about how to calculate a trading profit or loss and what can then be done with a loss. The last bit is the bit that I said too is probably the least important in the whole section, unless it comes up in the exam, of course, and suddenly it's important again. But I'd have thought the only way that this might be tested, it's such a small area, might be with a one-off Section A objective testing question. So hey, it's 2 marks, we need to know how to do it. Very specific. Premises used as both home and business premises, such as a small hotel or guest house, or again what we call them in the UK, bed and breakfast, or even a public house that offers accommodation there. What may happen is that the individual, the trader, actually lives in that property, and as well as living in it, they are again operating as a hotel, so they let rooms out in the hotel, the guest house, the bed and breakfast, or indeed the public house. And we've got an issue then about the expenses that are incurred in relation to the private use of the property. So what happens here is that if you wish, then under the cash basis you can elect for a flat rate private use adjustment to apply under the cash basis here in respect of the private use of the property for such expenses as food and heat and light. So you operate a small hotel, guest house, bed and breakfast, public house, and you provide food and drink there as well, of course, as heat and light. But what you've got is one electricity and gas bill for the entire premises, which covers both the business component and your own private component there. And you put all of the costs of food through the business in terms of those are the total costs, and you've recorded them all, and that's what you'd be looking to deduct. But you, of course, have eaten some of that food. You've drunk some of that drink, in which case there's a private element. Now again, what we would do without this in terms of the cash basis is just agree with HMRC a private stroke business use split of the expenses. And you can still do that if you wish. But if you want a simpler way of dealing with it, that what we can do is to use a flat rate adjustment here. Now it's a flat rate adjustment, so note what we're doing is to work out what is the add back in relation to our profits. We're not working out the allowable deduction, we're working out what is the disallowance, and we're adding that back in terms of our adjustment of profit process. Now we'll see that how it works in a moment in our example. But the particular flat rates that you'd need will be provided in the examination, in an exam question. So again, either in the question or on the rates and allowances page, probably indeed as a part of the examination question itself. And those are based on the number of occupants. Now again, those will be given to you, but examples here, if the property had one occupant there, so one person living in the property, one a sole trader, the add back would be based on £350 a month or part thereof, i.e. £4,200 per annum. If there were two occupants there, presumably spouses, it would be £500 a month, i.e. £6,000 per annum there. But those figures, and if they have had any updates from when I've recorded this to when you get to your exam, then you'll be told what the relevant figures are for however many occupants there may be, and you'll be told how many occupants there are there, whether it's just the individual or the individual and spouse and family, whatever. The flat rate add back does not include other property expenses such as rent or loan interest payments. Those, again, are all separately allowable deductions, so it's only in relation to this particular issue. Right. We've got example 7. Now, again, not very much information here, but we're told, Eve, a single lady. Now, in the question, if this were in the exam, you'd be told that for an individual, it would be based on £4,200 per annum as a single occupant in terms of the add back in this adjustment of profit exercise here. You'd be told that. Runs a small guest house in which she lives, and in which she lives, of course, there, that's the important point. Prepares accounts to the 5th of April each year, and for our year ended 5th of April 16, has a trading profit before any private use adjustment. So before the private use adjustment, so all of the expenses have been deducted, but we've got a trading profit of £23,000. The total cost for food, heating and lighting charged for this period amounted to £14,000. Right, what I want you to do therefore is, as per the requirement of the question, to state how the total cost of food and heat and light may be dealt with for tax purposes, and calculate Eve's adjusted trading profit, assuming the election for the flat rate private use adjustment has been made. So discuss, state what the options are, your normal rule with your agreed with HMRC split of what is business and what is private there, or what is now the system under the cash basis. You'll only have to use this, by the way, when using the cash basis, and you will be specifically told if the cash basis is to apply. You won't be expected to assume that maybe here I would apply the cash basis. You'll be told at F6 whether or not to do so. Okay, have a little think about that for a moment. And again, what we'll then do, we'll again pause it at this particular point in time, then come back and we'll discuss here what the issues are. So what we've got to state how the total cost of food and heat and light may be dealt with for tax purposes. Well, there's two options without, again, making any election for this flat rate scheme basis to apply. Then you'd have your normal agreement with HMRC. You'd have to produce evidence, of course, for it, showing what would be the business and private use, and you'd be adding back the private use element of that expenditure. You'd add back the private use. Rather than trying to go to the trouble and expense of finding that information, it would be very simple, of course, just to use the flat rate private use adjustment. And that, based on a single occupancy, would be an add back of £4,200. So at the moment, what we've got is a trading profit before any private use adjustment of £23,000. Under the normal rule, you'd agree the business stroke private use with HMRC in relation to this expense item, and of the expense of £14,000, you'd add back what the private use element may be. Other than that, you simply adopt here this flat rate scheme under the cash basis, and what do we therefore do? Add back to 23,000. What is the figure? This is a per annum, it's an annual figure for a single occupant. There you go, it's £4,200 there. So you just take 23,000 plus 4,200, and your revised adjusted trading profit, computed very quickly, very easily, one calculation, would be £27,200. Okay, that therefore completes our exercises in terms of Chapter 6, such that at this point in time, we should be able to adjust up a normal statement of profit or loss and make it acceptable for taxation purposes, most likely having to do that under the normal accruals basis, or we could even now do it under the cash basis if told so to do. What we can also do, if required, i.e. under the normal accrual system, not cash basis, is to compute and deduct capital allowances. And once we've got a figure of profit adjusted for taxation purposes for any given accounting period, whether it is the first accounting period, the final accounting period, or any accounting period in between, we will know the way by which we will determine the tax year in which that adjusted profit will then be assessed, using opening year's bases of assessment, using CYB, or thereafter using the closing year bases. What we've just got introduced to at the very end of this particular chapter is the idea, of course, that when traders trade, they don't always make profits. They may indeed sustain a tax-adjusted trading loss. And what we look at in Chapter 7 is how those losses may be relieved. There's a basic issue here, and that is that if HMRC are going to tax us when we make a tax-adjusted trading profit, then they must give us tax relief for when the business sustains a tax-adjusted trading loss. So the adjustment of profit, the capital allowance computations, will be exactly as before, except that the result will no longer be a positive, a tax-adjusted trading profit, but will be a tax-adjusted trading loss. What reliefs will then be available to the taxpayer for the losses so incurred? Well, that awaits us in our next chapter together.